guys, and welcome back to Mike and his whiteboard. My name is Mike, this is my whiteboard, and today we're going to finish off the Greeks by talking about beta. So yesterday we talked about correlation, and correlation is essentially measuring the mean of two different underlyings and determining whether they're on the same side or on opposite sides of the mean to determine a strong or weak correlation. So we kept talking about correlation and how it relates to beta, so today we're going to break down beta, and what I like to think about is basically, beta is the magnitude or the strength of the movement when we're talking about two different underlyings. So if I'm comparing something like SPY to Apple, for example, I know that they're going to have a strong correlation. So I know they've got a strong correlation, but now I want to know the magnitude of that. So I need to see a number that's going to tell me what, for 1% move in SPY, what kind of move can I expect to see in Apple? And that's exactly what beta does. So beta essentially takes a strong correlation, whether it's positive or negative, and gives you a number to give you an idea historically how it's been in terms of a percentage point move in SPY. So basically, when we're talking about beta, I'm going to break it down on the next slide here. We're going to look at two different underlyings, and we're going to show you how two different betas can look very, very different. So beta is essentially used to measure risk from a macro perspective. So pretty much we're looking at our portfolio or a certain position that we might have in an underlying from a market or macro perspective. So we like to use SPY because we consider the S&P 500 our market indicator. SPY is super liquid, so it's going to be very accurate in terms of probabilities, beta, etc. And there's tons of activity, so we're going to have a lot of historical data. So when we're looking at beta, pretty much we're looking at normally a 5-year time frame historically, and we're measuring an underlying against that 5-year time frame. So if we have something like Apple, and again, this triangle signal is basically delta. So delta is the rate of change of an options price given a $1 move or $1 increase or decrease in the underlying price. So let's say I've got a positive delta of 30 for Apple. So let's say I sold an out-of-the-money put spread, and that out-of-the-money put spread has a delta of 30. Now, if I were to beta weight that spread to an SPY here, we can see that I now have a beta weighted delta of 14. So basically what this tells me is that I might have a strong delta in terms of a 30 delta with just the raw position, but when I measure that raw position against that market move, it's a much lower delta here. So it's a great way to understand and pretty much measure your portfolio on a macro level and make sure that we're not too long or too short with any certain underlying. Now what's really important is that beta also gives us an understanding of what we're actually trading. So VIX is a volatility index that measures the volatility of the S&P 500. So if I've got a long VIX position and I don't understand what the VIX is, I might just say, hey, I think VIX is low and I think the VIX is going to rise. So maybe I did the same thing. Maybe I bought a call spread in the VIX. So I've got a 30 delta call spread in the VIX, but now when I beta weight this to SPY, since SPY and the VIX have a very negative, strong correlation, pretty much I'm going to have a negative beta weighted delta. So although I've got a positive or bullish position on the VIX, when I compare it to SPY, I've got a negative beta weighted delta. And that's generally because when SPY or the market creeps up, the VIX is usually going to go down, and when the market tends to drop, the VIX is going to spike up. So when we were talking about correlation yesterday, the VIX and SPY essentially have a very strong negative correlation because they're normally on the other side of the mean when we're looking at historical price. So what's really important is to make sure that when we're looking at this, we basically have a strong correlation. So correlation is key when we're looking at beta because if I don't have a strong correlation, either positive or negative, then regardless of what the beta number is, it might not be very accurate. So when we go to the next slide here, we can clearly see that when I'm looking at something that has a weak correlation, in this case we're looking it's going to be pretty foggy. We've got this cloud here over it because I'm not too sure because I've got a weak correlation. So although I might have a beta number, it might not be very accurate because if SPY does move up, for example, if we're going back to the Apple example, if SPY goes up and let's say Apple didn't have a strong correlation with SPY, then I might not take that beta number for granted. So basically when I'm looking at the beta number, if it might be 2.0, maybe it'll actually be 1.5 when I'm looking historically as to how that move actually affected Apple. So what's really key is having a strong correlation here. So when we've got strong correlations and we're measuring it against an underlying with either a strong positive or a strong negative correlation, we're going to have a beta number that can be pretty accurate, and we're going to be able to trust that number. So when we're looking at things like SPY, we're going to make sure that we either have a very strong positive correlation or a very strong negative correlation before we're looking at beta. And if we're looking at different underlyings, like let's say I like to trade oil a lot, I might want to beta weight my oil position to something like CL or some other liquid oil product so that I know that it's definitely going to be correlated or have a high negative or positive correlation, and I'm not looking at something that might have close to a zero correlation like we were talking about yesterday. So another way that's cool with correlation in beta is that we can see it in the Doe platform. So the next slide here is the portfolio graph page of the Doe platform. So what's cool is that we've got the beta weighted information along the right here, and we've got our beta weighted delta at the very top of the Doe platform. So if I've got multiple positions on, it's automatically going to beta weight my deltas here. So it's automatically going to be to SPY. And again, we use SPY because we think it's the market indicator here. It's a super liquid product. So if I've got multiple positions selected down here, it's automatically going to beta weight this graph. And what's cool about this graph is that you can drag your cursor along this line here, and these values along the bottom are going to change. So you'll be able to drag it along, see where your potential profit or loss might be if SPY reaches a certain point here. And if you want to look at your traditional view, you can just unselect all the positions and just look at one underlying, and it will essentially not beta weight to SPY anymore. It'll just give you that traditional risk graph. So let's look at some takeaways here for beta. So again, beta is a way to measure risk from a market perspective, and we generally use SPY, which is the ETF of the S&P 500. So correlation is related to beta again in a sense that correlation is going to give us a very positive or very negative correlation, and when we're talking about beta, we're essentially making sure that when we have a strong correlation, we're not too long or short in a certain underlying. And another takeaway here is that it gives us a better understanding of what we're actually trading and how it relates to the market. So like we saw with the VIX example, although I might have a bullish VIX product or a bullish VIX position, if I beta weight it to SPY, you can see that now I have a negative delta. So just understanding these things and understanding how different beta weights can affect your portfolio as a whole is going to make you a better trader. And last but not least, strong correlation, positive or negative, indicates a more reliable beta. So this is probably the most important takeaway. I'm not going to want to look at underlyings that are not very strongly correlated because again, if there's no clear correlation, then regardless of what the beta number is, if I'm looking historically, it might not be very accurate. And when I'm looking at beta, I want to look at an accurate number. So first I'm going to make sure that I either have a strong positive correlation or a strong negative correlation, and then look at beta from there. So hopefully this has been helpful. Thanks so much for tuning in. My name is Mike, and if you have any feedback or questions at all, shoot me an email at support@doe.com or support@, or you can tweet us at DoeTrading at DoeTraderMike, and we will begin again next week on Tuesday with another episode of Mike and His Whiteboard.
Hey everyone, thanks for watching our video. If you liked it, give it a thumbs up or share it with a friend. And don't forget, click below to watch more videos, subscribe to our channel, or go to our website at